One of main Amundi conviction is that Chinese assets deserve a key and standalone place in global portfolios. Chinese assets are no longer emerging nor peripheral in portfolio construction. We base our conviction on two pillars. The first one is the rebalancing of China's growth engine from exports to domestic demand, with an emphasis on supply chain independence and security. Even the current regulatory pressure should be seen as a tool to boost competition and reduce systemic risks, both welcome conditions for attracting capital. The second is the internationalization of the RMB as a key currency for trade, capital, reserves and savings. China has resisted the temptation to embark on unorthodox monetary and fiscal experiments, in marked contrast to the US, which saw the greatest central bank governmental intervention of all time, upending all tenets of financial discipline. Now again, with the economy losing steam and the looming tapering in the US, China stays ready to support its economy, but also fine-tune easing measures to safeguard its currency. On the currency front, we note that the RMB is taking on for Asia a role similar to that of the Deutschmark in Europe 4 decades ago. This nascent Asian currency bloc will provide some insulation from US-related headwinds and strengthen the commercial ties in the region just when the US has disengaged from it. The upcoming round of tapering in the US could help further at the RMB internationalization, as emerging economies and investors in general will wish to tackle their addition to the US dollar. For investors, there are three implications. First, Chinese assets, cash and governmental bonds in particular, will likely be the main oasis of positive real returns for the foreseeable future. This is because the recent hyper-Keynesianism in the US carries its own price tag in terms of rising inflation, currency devaluation, and higher risk premia. For investors, the preservation of purchasing power per unit of risk will be the name of the game in a more inflationary world where real returns will matter most. Second, greater autonomy of the Chinese cycle will provide better diversification benefits and the opportunity to gain exposure to areas of higher future growth. The development of the middle class and domestic consumption may help reducing the dependence from global trade. The shift away from low value-added manufacturing activities towards an innovation-based economy will provide opportunities in strategic sectors such as semiconductor, artificial intelligence, quantum computer, clean technologies, industrial automation and robotics. Chinese growth stocks are largely internet giants. As local champions develop out of the local innovation drive, a broader set of growth companies to invest is available for investors to diversify their risks. Third, like the Deutschmark in the 1970s and subsequently the euro, global investors should view the RMB as a store of value, while the US dollar could well see an erosion of its value due to policy excesses.